You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Our goal today really is to cut through all that market noise you're hearing, the mixed signals from central banks, the geopolitical stuff flaring up, the tariff talk. We want to give you the clearest possible signal. So we're diving into the global briefing from October 16th, 2025. We'll hit FX, commodities, trade, and, well, how it all connects.
Yeah, and if you just take a step back for a second, the big picture right now, it's all about tension. I mean, extreme tension. We're navigating this really critical balance. It's almost dizzying. On one side, you've got these hopes for central banks actually softening up, especially the Fed, right? Expectations for more easing. That's like the global tailwind.
Okay.
But on the other side, that tailwind is getting hit hard by some really high geopolitical risk. Sharp tariff talk, that very, very fragile truce in the Middle East, and that tension, that's what's moving everything from the dollar pulling back to gold sitting near highs.
Right, let's start there then. The softer Fed idea. Why is that specific signal putting pressure on the dollar right now? And maybe more interestingly, which currencies in Europe seem to be benefiting the most?
Okay, so the US dollar, if you look at the DXY index, that's the dollar against its main trading partner. It's definitely, on the back foot.
Yeah.
That retreat really took hold after the comments midweek. If you look closely at what the Fed's been saying lately, it's consistently cautious. Cautious on growth ahead, cautious on jobs holding up.
Doesn't sound earth-shattering on its own.
Exactly. But it reinforces what investors are already expecting, future policy easing, lower rates down the road. And when that prospect looks more solid, the dollar gets pushed down. It just becomes less attractive to hold dollar assets, relatively speaking.
So the dollar falling is the tide lifting some boats. But maybe not all equally. Europe seems surprisingly strong right now. The euro, for instance, holding above 1.16. Is that just dollar weakness or is something else going on?
It's a bit of both, but the domestic angle is really important here. The euro is grinding higher, yeah, but it's getting a significant boost from better political optics, especially around France and its budget plans. Remember all the worry about fiscal discipline in the Eurozone?
For years, yeah.
Well, right now, there's this relative calm, this perception that they're committed to targets, and that helps sentiment. It puts the euro in a great spot to really benefit from the dollar's weakness.
And sterling, the pound, seems to have an even clearer story. The chancellor signaled higher taxes for the wealthiest, ruled out austerity. Sterling jumped back over 1.34 pretty quickly. But why does the market buy that? Isn't taxing the rich usually seen as bad for growth?
That's the interesting part, isn't it? The market seems to see this specific mixed taxing top earners but avoiding deep spending cuts as credible tightening without killing demand. It's kind of an unusual political move, right? Manage the deficit but try to shield the average consumer. And for now, traders seem to think, okay, this is a plausible way to fix the books without tanking the economy. It's quite a sophisticated reaction, really.
Okay, let's pivot over to Asia. We're seeing some real divergence there. Japan first. A Bank of Japan board member, Tamura, was arguing rates should get closer to neutral to avoid sharper hikes later. For someone maybe not deep in FX, how does just talking about neutral impact the yen today?
It's all about those rate differentials, the gap between what you earn holding yen versus dollars. Right now, that gap is huge. So when a BOJ official even hints at moving rates closer to neutral, even if it's way off in the future, it nudges expectations just a tiny bit. It suggests that gap might shrink eventually. And that tiny nudge encourages some traders to maybe hold yen, giving it a little support, because the benefit of holding dollars might lessen over time.
Got it. Meanwhile, China seems to be providing a bit of an anchor.
Yeah, the PBOC, that's the People's Bank of China, they guided the yuan midpoint stronger at 7.0968. By setting that official rate higher, it gives the onshore yuan, the CNH, a bit of stability. And that's important. It helps calm regional risk sentiment generally. It allows currencies like the Kiwi, the New Zealand dollar, to hold steady even while its neighbor, the Aussie, the Aussie slipped.
And an Aussie slipped purely on its own domestic news, right? Bad jobs data.
Absolutely. The Australian dollar took a direct hit from its own economy. Employment missed, the jobless rate ticked up to 4.5%. It just shows how powerful those local economic signals still are, even when the big global tide, like dollar weakness, is moving in one direction.
Okay, so summing up FX,
Yeah.
the dollar's pullback is the main theme, but it's the currencies with solid domestic stories like the euro and sterling that are really benefiting.
That's it exactly. They're showing either fiscal discipline or political calm, something credible locally, and that lets them ride the wave of softer U.S. rate expectations much better than others still dealing with, their own economic issues.
Let's carry that idea of stability or lack thereof into commodities, because here, wow, what a contrast. Gold looks incredibly strong, near record highs, but oil is acting really cautious.
Gold is the classic uh-oh asset, isn't it? And its position is frankly astonishing. It's holding strong above $4,200 an ounce, and we have to pause on that number. USD 4,200, that's extreme. It tells you this isn't just about inflation hedging. It's deep defensive positioning. It's duration demand. It signals big investors are convinced lower real rates are coming and that geopolitical risk is really severe. So, weaker dollar, expected Fed easing. It all feeds this historic move into defensive assets.
That number really underlines the nervousness out there. But crude oil, it's not playing along. Its upside got capped pretty hard, even after starting the day higher. What put the brakes on so quickly?
Short-term supply picture, mostly. The immediate hit came from private inventory data here in the U.S. It showed a bigger than expected build in both crude oil and gasoline stocks. When you suddenly see a glut like that in a major consumer market, it tends to override other factors, at least temporarily.
And then there's this medium-term push and pull on supply we keep hearing about. What are the main forces creating that friction?
Yeah, you've got two big things pulling in opposite directions.
Yep.
On the bullish long-term side, the head of Saudi Aramco, he's out there warning very clearly future shortages are coming if we don't see sustained investment. That puts a sort of floor under prices.
Okay, the long view.
But checking that immediately is news about Russian supply. India apparently told the U.S. they won't buy Russian oil, and their refiners are prepping for gradual cuts. That potentially frees up supply elsewhere in the short term, which dampens the immediate upward pressure on prices.
And finally, copper. Kind of the bellwether for industrial health. Is it following gold's defensive move or oil's caution?
Definitely caution. Copper's pretty subdued after pulling back recently. And what's interesting is copper reflects the physical economy concerns very directly. Two things seem to be holding it back. One, those U.S.-China tensions are obviously still simmering. Industrial players don't want to bet big on global trade right now. And two, maybe more importantly, Chinese inflation data. It's signaling pretty soft domestic demand. The world's biggest metals user just isn't pulling as hard as expected. Copper's flashing yellow on global trade, no doubt.
Okay, this is where things get really messy, right? The direct link between political talk and market risk. President Trump saying the U.S. is in a trade war with China, framing tariffs as national security. That sounds like a major escalation.
It is. That rhetoric is a critical shift. Calling it a trade war, and especially linking tariffs explicitly to national security, that broadens the justification for future actions massively. It just creates huge uncertainty.
And yet, officials at the USTR, the Trade Representative's Office, they sounded much more pragmatic. It almost seems contradictory.
It creates enormous ambiguity. The USTR folks suggested recent Chinese export controls might not actually happen. Okay, that's calming. But then, in the same breath, they left the timing for any potential U.S. tariffs totally up in the air. So the market is stuck trying to figure out, is the tough talk just performance? Or is actual enforcement coming soon? High-level rhetoric versus bureaucratic reality. It's confusing.
But amidst all that, we are seeing some other tariff talks, maybe moving towards resolution. That offers a little hope.
We are, yeah. South Korea sounds optimistic about resolving its issues with Washington soon. Mexico is actively negotiating discounts on truck part tariffs, and significantly, that domestic probe into appliance imports. It found no widespread tariff dodging. That kind of cools down some of the corporate noise that was driving headlines earlier.
Let's shift to maybe the highest stakes situation. The Middle East ceasefire. Yes, but everyone keeps calling it fragile. What makes it feel so fragile right now?
It feels fragile because both sides are openly preparing for fighting to resume. Israel's defense minister ordered plans ready to, quote, defeat Hamas if things break down. Meanwhile, Hamas says they've handed over all the hostages they currently tan, implying getting more requires specific equipment or conditions. So the truth seems to be holding more because of operational needs and intense international pressure rather than any real resolution of the core problems.
But there are efforts underway to stabilize things, which must be helping calm markets a bit.
Absolutely. U.S. officials called talks on aid delivery very positive. And critically, this idea of a multinational stabilization force for Gaza, it seems to be genuinely taking shape. Those efforts have definitely helped cool the immediate risk premium priced into oil, but that premium is still incredibly sensitive. Any hint the ceasefire could crack, and it'll likely jump right back up.
It's really something, tracking those intense regional flare-ups right alongside, PBOC guidance or the DXY's drift. It shows just how tangled the global risk map is.
And there are other hotspots too, right? Oh yeah, Ukraine, for example. President Trump floated the idea Putin might accept a settlement. Ukraine says, no way, we want to go back on offense. Markets watch that constantly for energy and grain route impacts. And then further south, the U.S. confirmed CIA operations in Venezuela. Caracas immediately condemned it, naturally, as violating international law. It just injects another regional risk factor into the mix, reminding us instability isn't just confined to one area.
Before we wrap up and summarize, we have to touch on the domestic political scene here in the U.S. That's casting a pretty big shadow over everything.
Yeah, the U.S. government shutdown, still unresolved. And the Senate looks like it's about to leave town. Markets watch this for two big reasons. First, there's the general drag on the economy, the uncertainty it creates locally. And second, the data delays. The shutdown means less economic data is coming out on schedule. That makes it harder for everyone, including the Fed, to get a clear picture of what's actually happening.
Right. So if you're trying to navigate this complex environment, the dollar's move, gold's weird strength, oil's push-pull, all the geopolitical noise, what are the, say, 3 key threads to really keep watching?
Okay, 3 things that cut through it all. Number 1, how quickly and how much the Fed actually leans into easing. That's still the main driver for the dollar and assets like gold.
Makes sense. Number 2.
Number 2, does the U.S.-China trade situation escalate from just tough talk to actual enforced tariffs? That ambiguity is probably the biggest risk right now.
Okay.
And number 3, does the Gaza ceasefire hold and maybe become something more durable, or does it crack? That really dictates the energy risk premium and just overall global market jitters.
It really is an incredibly dynamic picture right now.
Yeah.
Tracking the dollar's drift, gold's amazing resilience, while trying to figure out what's real and what's rhetoric on tariffs and ceasefires. Thanks for helping us sort through some of that complexity.
My pleasure. And maybe a final thought for you, the listener, to chew on. Given that this U.S. government shutdown is delaying economic data, right, thinning out the calendar, how does the Federal Reserve judge how fast and how much to ease policy if the key numbers they normally rely on, jobs reports, inflation data, are suddenly unavailable or unreliable? Does making policy get inherently riskier when the picture is less complete?
That's the big question, isn't it? Making huge decisions based on incomplete data, under pressure to act. Definitely something to think about as you track these global currents. We'll catch you next time for the Deep Dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.